Picture Washington, D.C. on a gray Tuesday morning in early 2026. The monuments still gleam. The flags still snap in the cold wind above the Capitol dome, same as they always have. But 3 floors below street level, inside a windowless conference room at the U.S. Treasury Department, a single spreadsheet is quietly announcing the end of an era. The common story is that America is too big to fail. We have heard it repeated for decades like a prayer at Davos, on cable news, in earnings calls, in White House press briefings. The dollar is invincible. The bond market will always show up. America always finds a way. But this story was never about invincibility. It was always about the ledger. And in 2026, the ledger is calling in every dollar America ever borrowed against its own future. This is not a story about war. It is not about elections or political parties. The balance sheet does not care who won in November, who controls the Senate, or what the president said on television last week. It only knows one language, numbers. And the numbers, right now, are speaking in a tone that should terrify anyone who understands what they mean. For a brief, extraordinary moment in modern history, America stood alone at the summit of the financial world. The post-Cold War decade of the 1990s saw the United States posting budget surpluses for the first time in a generation. The economy was expanding rapidly. The technology revolution was restructuring global commerce in real time, and American companies sat at the absolute center of it all. The dollar was the bloodstream of the entire global economy. Every oil contract, every major trade deal, every international bond issuance was priced in American currency. Central banks from Beijing to Brasilia hoarded U.S. Treasury securities like gold bars in a vault. At its peak in 2001, the dollar represented nearly 73% of all global central bank reserves. Think about the scale of that. Almost 3/4 of the world's entire financial safety net was denominated in a single nation's paper money. That is not merely economic power. That is a form of financial sovereignty no empire in recorded history had ever fully achieved before. And America borrowed against that privilege. Why wouldn't it? The world was handing it a credit card with no visible spending limit and near zero interest charges. It was the greatest financial arrangement ever constructed in the history of sovereign finance. The entire machine ran on one unspoken assumption that the conditions making it possible would never fundamentally change. But beneath the surface, the foundation was already rotting. The trap was built slowly, methodically, over 13 years of what central bankers politely call accommodative monetary policy. After the 2008 financial crisis nearly destroyed the global banking system and dragged the real economy toward a depression, the Federal Reserve dropped interest rates to near zero. They stayed there with only brief and shallow interruptions for more than a decade. In that low-rate environment, the U.S. Treasury did exactly what any rational borrower does when money is almost free. It borrowed massive. The national debt tripled, climbing from roughly $10 trillion in 2008 to over $31 trillion by late 2022. But because rates were so historically low, the annual cost of servicing that debt stayed deceptively, dangerously manageable. This was the addiction. Not to spending itself, though the spending was prodigious, on a scale history had rarely witnessed in peacetime. The real addiction was to cheap money, to the quiet, invisible subsidy of near-zero rates that made every fiscal decision look more sustainable than it actually was. Every Treasury Secretary, every budget director, every fiscal watchdog in Washington grew dependent on one quiet miracle, that the cost of debt would never meaningfully rise. The antagonist in this story does not carry a weapon or command an army. It does not wear a uniform or appear in newspaper photographs. It is a number, an interest rate, and it spent 13 years sleeping in the basement of the Federal Reserve, fed and pacified by crisis after crisis that justified keeping it suppressed. When it finally woke up in March 2022, it woke up hungry. By mid-2023, the federal funds rate had climbed to between 5.25 and 5.5%. The monster that had slept through the feast was standing at the Treasury door with a bill that nobody had budgeted for. The mechanism of collapse is not dramatic. It does not arrive with sirens or emergency broadcasts. It does not break into the evening news with a special bulletin. It arrives through a process called debt rollover, the most dangerous financial mechanism that almost nobody watching this has ever heard explained clearly. U.S. Treasury debt is not a single loan with a single repayment date. It is a constantly rotating portfolio of securities with different maturities running simultaneously. Some are 30-year bonds, some are 10-year notes. A very large portion consists of Treasury bills that mature in 1 year or less. During the near-zero rate years, the Treasury leaned heavily into short-duration debt because the rates were essentially nothing. Why lock in a 30-year bond at 2% when you can borrow for 3 months at a fraction of a percent? It was rational. It was logical. It saved money in the short term. It was also a slow-motion trap set to spring a decade later with the force of a collapsing dam. By the time 2025 arrived, approximately $9.2 trillion in U.S. Treasury securities were scheduled to mature within the following 14 months. That is not a projection. Those bonds had already been issued. The dates were already printed. The ink was already dry. The only remaining question was the rate at which America would refinance them in a fundamentally different interest rate environment. The answer was brutal. Those bonds were originally issued between 2020 and 2022 when interest rates sat between 0 and 1%. The new bonds replacing them carried rates between 4.5 and 5.5%. America was refinancing the largest sovereign debt pile in human history at rates 4 to 5 times higher than it had been paying before. In fiscal year 2023, net interest payments on the federal debt reached approximately $659 billion. By fiscal year 2024, that figure surged past $880 billion. The Congressional Budget Office projected annual interest costs would cross $1 trillion by 2026, and some analysts believed they would cross that threshold ahead of schedule. Let that number sink in. $1 trillion every single year, paid directly to bondholders, producing not a single road, school, hospital bed, or investment in any future at all. It is the cost of yesterday's decisions extracted mechanically from tomorrow's resources, paid in today's cash to creditors who will spend it somewhere else entirely. By 2025, the interest expense to revenue ratio, the percentage of incoming tax dollars consumed entirely by debt service, had climbed toward 20%. 1 in every $5 the federal government collected went directly to creditors before a single program was funded. Not to defense, not to Medicare, to interest. The machine was beginning to digest itself, and the federal debt wall was not arriving alone. American corporations had also gorged on cheap money during the low-rate era. Approximately $1.9 trillion in corporate bonds was scheduled to mature between 2025 and 2027. Companies that locked in borrowing costs at 2 to 4% would now refinance at 6, 7, or 8%. For businesses on thin margins, that math translates directly into layoffs, reduced investment, and outright default. Then add the commercial real estate crisis gathering force in the background. Roughly $1.5 trillion in commercial property loans were set to mature between 2025 and 2028. Office vacancy rates had hit historic highs across every major American city. Properties were worth far less than the debt secured against them. Regional banks holding disproportionate shares of these loans faced potential losses capable of triggering serious localized banking stress. The gold was draining. The credit was tightening. The walls were closing on 3 fronts at once. The federal debt wall, the corporate debt wall, and the commercial real estate wall were not 3 separate crises. They were the same underlying problem expressed simultaneously at 3 different levels of the same economy, converging in the same narrow window of time. The flood was coming from every direction, and the drains had been welded shut. Every debt crisis produces a document, not a battle plan or a declaration. A document. A quiet, technical, official piece of paper that historians will later identify as the precise moment when collapse became structurally irreversible. In the case of America's 2026 reckoning, that document is the Congressional Budget Office's long-term baseline projection. Understand what that document actually represents. It is a forecast built on the most optimistic, reasonable assumptions the analysts could justify. No recession before 2034. No major military conflict. No new pandemic. No financial crisis of any kind. This document represents the best-case scenario. And even under that best case, interest costs continue rising faster than revenues, faster than GDP, faster than any other budget category. Indefinitely. Without reversal. In a room we will never enter, the conversation that took place among America's most senior fiscal decision-makers in late 2025 would have sounded something like this. The math does not close. Under any realistic growth projection, interest costs outpace revenue every single year going forward. There is no combination of spending cuts and tax increases that is simultaneously large enough to matter and politically survivable enough to attempt. And then, after a silence heavy enough to feel like concrete, someone said the three words that foreclosed everything. So we manage it. Not fix it, manage it. Day by day, auction by auction, rolling the problem forward and hoping for conditions the arithmetic says cannot arrive. This was the foreclosure. Not a dramatic declaration, not a market crash on camera. A quiet institutional surrender to the mathematics, an agreement that the window for genuine resolution had closed, and that from here forward, the only question was how to distribute the cost while maintaining enough surface stability to avoid an immediate rupture. History has a name for this strategy. It is called financial repression. When a state cannot explicitly default without destroying its market access, it defaults on its citizens instead. It allows inflation to run persistently above interest rates, silently eroding the real value of its debt. It keeps real returns negative for savers. It transfers wealth from those who hold cash and bonds to the state itself, gradually, invisibly, without a vote, without a press conference, without ever once calling it what it is. It is the oldest tax written in the Book of Sovereign Power. The moment the money effectively runs out does not look like a Hollywood crisis. There is no slow-motion bank run, no traders collapsing on a trading floor. It looks like a treasury auction that draws slightly weaker demand than forecast. It looks like a bond yield that ticks up 3 basis points without an obvious catalyst. It looks like a credit agency revising its outlook from stable to negative on a slow Friday afternoon when the financial press is covering something else entirely. Then it looks like something people feel in their own lives. It looks like a grocery bill running 20% higher than last year with no single explanation. It looks like a retiree whose fixed income buys measurably less each month, who cannot point to the precise moment it shifted, but who feels it in every transaction. It looks like a small business owner whose loan just repriced at a rate that makes the entire model no longer viable. This is the social consequence of sovereign insolvency in a reserve currency nation. It does not arrive as a single catastrophic rupture anyone can name. It arrives as a sustained grinding erosion of economic possibility for everyone without the assets, the sophistication, or the mobility to position ahead of it. Sovereignty is solvency. That is not a metaphor. It is a law of fiscal gravity. A nation that cannot balance its ledger cannot, over any meaningful time frame, preserve the sovereignty that ledger was always financing. Between January 2020 and December 2024, cumulative consumer price inflation in the United States exceeded 20%. Real wages adjusted for that inflation barely held even and in many cases declined. For lower-income households concentrated in food, housing, and energy, the categories where inflation ran hottest, real purchasing power fell measurably. The default was already in motion. It simply was not being called that. The trap operates like this in its purest form. If the Federal Reserve cuts rates to ease the refinancing burden, it risks reigniting inflation, functioning as a hidden tax on every person holding dollars. If it holds rates elevated, the interest burden accelerates and the deficit expands. If Congress cuts spending dramatically, it triggers economic contraction and political collapse. If it raises taxes aggressively, it shrinks the revenue base the debt reduction requires. Every door leads to another corridor with the same locked door at the end of it. The generational cost of a sovereign debt reckoning is never fully accounted for by the people who built it. They retire. They write their memoirs. The final bill arrives decades later, paid by people who were children when the decisions creating it were made. After the Second World War, the United States carried a debt-to-GDP ratio of approximately 119%, comparable in scale to where it stands today. It took roughly 25 years of sustained expansion, broad demographic growth, and deliberate financial repression to bring that ratio down to approximately 32%. 25 years. And those 25 years rested on every structural advantage simultaneously. An uncontested industrial economy because Europe was rubble and Japan was rebuilding from ash. A baby boom expanding the workforce every single year. A Bretton Woods system enshrining the dollar as the world's only reserve currency. Cheap domestic energy. Rising real wages broadly shared through strong labor institutions. No serious geopolitical competition anywhere on the planet. The 2026 refinancing wall arrives with almost none of those tailwinds. The United States today carries an aging population, decelerating labor force growth, decades of offshored manufacturing capacity, a declining reserve currency share, volatile geopolitically exposed energy, and a strategic environment defined by intensifying great power competition. The post-war playbook cannot be rerun because the conditions that made it work no longer exist. Japan is the most instructive living parallel. In 1990, Japan's asset bubble burst after years of speculative excess. Over the following 3 decades, the government ran persistent deficits and accumulated debt exceeding 260% of GDP. The Bank of Japan held rates at or below zero for most of that period. An entire generation of Japanese workers experienced no meaningful real wage growth. The standard of living did not collapse in a single moment. It diminished slowly, persistently, in ways that never made a single major headline, but that fundamentally reshaped the economic experience of an entire society across 30 years. The generational dimension of what is unfolding is ultimately not a fiscal statistic. It is a future being consumed in the present. Every $1 trillion paid annually in interest is $1 trillion not invested in infrastructure, scientific research, education, or the technological development that determines which nation leads the next century. The interest bill is not merely a budget problem. It is a systematic liquidation of national potential, conducted quietly, automatically, contractually, without a vote, without a debate, without the people paying it ever fully understanding what is being taken from them. When sovereign debt becomes structurally unsustainable, history shows a consistent outcome. The burden shifts downward. Governments must preserve access to credit markets, so bondholders are protected while adjustments fall on the public. Pensions are reduced, services are cut, currency is inflated. In hyperinflation, in the Weimar Republic, owners of factories, land, and foreign assets preserved wealth, while savers holding cash and government bonds were wiped out. During the post-2010 debt crisis in Greece, many institutional creditors were shielded, but ordinary retirees faced severe pension reductions. The pattern repeats. Those with hard assets adapt. Those without absorb the cost. So here is where this story leaves you. Not at an ending, but at a continuation. The 2026 debt crisis is not a dramatic collapse marked by a single headline. It is a gradual narrowing of national flexibility, unfolding through declining purchasing power and shrinking public capacity. Each downturn becomes harder to fight because the stimulus room has already been spent. Each global commitment becomes heavier because interest payments steadily crowd out other priorities. Investments in infrastructure, education, innovation, the foundations of long-term strength, must compete with obligations that rise automatically, regardless of growth or political will. The bonds are issued. The rates are higher. The trajectory was set years ago under assumptions that no longer hold. Institutions cannot easily reverse course without risking the instability they seek to avoid. The question is no longer whether the cost arrives, but who ultimately absorbs it. History shows that sovereign debt cycles resolve, often at the expense of those far removed from the decisions. If you value analysis that examines the mechanics beneath the headlines, subscribe. The next pattern is already forming.